Look at any active trading board, and the appeal of scalping is immediate. You're capturing tiny, minute-by-minute price fluctuations, cashing out quick profits, and closing your screen with zero overnight risk. This chart shows the mechanical difference between two totally distinct trading philosophies. On the left, a traditional swing trader waits days to capture a single massive 100-pip move. On the right, the scalper ignores the macro trend entirely, darting in and out to snatch a rapid series of tiny, jagged movements. Let's zoom in on the right side of the screen. The mathematical target for a scalper is highly constrained. You are aiming for a precise window of just 5 to 15 pips per trade. But here is the friction point that wipes out most beginners. If you are targeting a 5-pip profit, a standard 2-pip spread instantly eats 40% of your potential gain before the market even moves. Scalping success relies on a defensive mathematical battle against execution costs, moving past the need for broad market predictions. To survive that math, you have to ruthlessly optimize every variable you control: the specific currency pairs you select, the exact minutes you trade, and the infrastructure of your broker. Out of the dozens of currency pairs available on your platform, only a tiny fraction actually possess the structural traits required to survive on a 1-minute chart. We can evaluate every pair using this matrix. To scalp profitably, you need high liquidity on the x-axis, which guarantees a tight spread, and predictable volatility on the y-axis to actually provide the movement. Let's plot exotic pairs, like the US dollar against the Turkish lira. They land squarely in the danger zone. Their severe lack of liquidity results in massive spreads, meaning you need huge, erratic price movements just to break even. Now look at the euro against the US dollar. This is the undisputed king for scalpers. Its unmatched global trading volume guarantees the razor-thin spreads required to make a 5-pip strategy viable. The British pound, or cable, plots slightly differently. It moves more pips per hour, offering more setups. But that comes with a distinct trade-off: slightly wider spreads and a higher susceptibility to market noise. Choosing your pair is not a stylistic preference. Sticking exclusively to the major pairs is a structural baseline for your profitability. Even the major pairs have moments where their predictable volatility entirely breaks down. That happens during scheduled high-impact economic releases, like the Consumer Price Index or non-farm payrolls. This timeline graph illustrates a normal trading session, but when price hits that vertical line marking a CPI release, it can violently swing 50 pips in a matter of seconds. In the moments before the data hits, brokers drastically widen their spreads to protect themselves, a mechanical shift that destroys your tight profit margins. This widened spread results in slippage, where the market moves so fast your order is filled at a different price than intended. This bypasses your stop loss, turning a micro trade into an uncontrolled loss. The professional approach to this environment is simple: don't play. Flatten all your open positions and stay entirely out of the market 15 to 30 minutes before and after a major release. Willingly sitting out a massive, explosive market move feels counterintuitive, but it is the exact price a scalper pays to protect their capital from manufactured spread traps. Even if you trade the right pairs at the right times, there is a final, hidden hurdle: the compounding cost of your trading platform's infrastructure over hundreds of transactions. This matrix breaks down the math. If you use a standard retail market maker broker, you are typically paying an average 1.5 pip spread on every single trade you execute. Project that over a high-frequency timeline. If you execute 100 trades in a day, you have to generate 150 pips of pure profit just to keep your account balance at zero. Now contrast that with an ECN environment, using FXNX as the benchmark. By accessing raw 0.0 pip spreads and paying a small fixed commission, your break-even requirement drops to a fraction of the standard retail account. Furthermore, direct market access and institutional execution speeds eliminate latency. That ensures your critical risk-to-reward ratios actually function in reality, not just in theory. Attempting to scalp on a standard spread account means your infrastructure is actively working against you. Upgrading to zero spread execution is a non-negotiable tool for survival. Scalping is psychologically demanding. A rapid succession of micro-losses can easily trigger emotional, rule-breaking behavior, often leading to destructive revenge trading. To counter that emotion, you need a strict mathematical anchor. You must never risk more than 1% of your total account equity on any single microtrade. Your stop-loss math has to be equally rigid. If you are targeting a 5 to 10 pip profit, your safety net must be placed at a tight 5 to 8 pips. This maintains the positive expectancy you need over hundreds of iterations. The 1% rule provides massive resilience. A devastating string of 5 consecutive losses only results in a 5% total account drawdown. You remain mathematically alive to trade another day. This flowchart maps out your exact next steps based on your current experience level. If you are a beginner, stick exclusively to the euro versus the US dollar. Its unparalleled liquidity acts as a safety net while you learn to read microstructures on the 1-minute chart. If you are intermediate and need more action, graduate to the British pound or the US dollar against the yen. But you must slightly widen your stop losses to absorb the natural increased volatility of those specific pairs. Consistent profitability in scalping is a marathon of strict math. It depends entirely on zero-spread ECN infrastructure, total news avoidance, and ironclad emotional discipline.